Right, guys. So this is chapter 20 on associates. Associates, a nice little tag on, and I think by working through the examples, we will see all the different additional entries. We started talking about this in class on Friday. So our aim is, of course, to define what an associate is, and really discuss this principle of using what's referred to as equity accounting. So really your share of the profit. So we are not using control accounting or IFRS 3, 10. So to consolidate, absolutely not, no. And then prepare a statement of financial position, which includes a subsidiary and an associate. And then, of course, same thing here, a subsidiary and an associate. So what is an associate? I highlight several times this spectrum. I can't draw straight lines. This spectrum of owning, say, 5 to 10% of the shares of a company, to owning between 20 and 50%, to owning more than 50%, where you actually control the thing. So I've talked about here, you just really have a financial asset, don't you, in shares. And you just hold them at fair value, whether through profit or loss or through other comprehensive income, depending on the designation you've attached to them. Again, depending on the relevance and the nature of the income flows as a result of that asset that you hold. But in this realm of 20 to 50%, we talk about having significant influence. And as you can imagine, if you're owning 40% of the shares or 35%, you do have some say on the board, but not enough to control it. So the question is, how do we recognize it? So we recognize it as this idea of having significant control. So significant influence is the power to participate in the financial and operating policy decisions of the investee, but it is not control. And this is assumed to be a shareholding of 20% to 50%. Equity accounting is the method of accounting whereby the investment is initially recorded at cost. Right, so initially recorded at cost. So when you buy the thing, you debit your investment and credit bank. Let's just assume you paid out of the bank. And then you can see here it says, and it's adjusted thereafter for the post-acquisition change. So whatever your share of profit post-acquisition, you literally add on to your investment, right? And that's pretty much it. The effect of this, of course, is that the consolidated statement of financial includes, of course, 100% of the assets and liabilities of the parent and the subsidiary, of course, on a line-by-line basis. But then, of course, you will also have that investment of the associate in there, with just the cost of the investment, what you paid for it, plus your share of post-ac reserves of the associate, as if you like. So hopefully this slide will say a few things that I wanted to add on to this. The consolidated statement of P&L, same thing. We're only consolidating the subsidiary, and then we just literally have a single line of profit of the associate that's due to us, right? I mean, it's profit that's come to us, if you like, and so we recognize that. That's what we recognize. Accounting for associates according to this, that the relevant standard is IAS 28. The equity method is what's normally used. We do not use if the investment is classified as held for sale, in accordance with IFRS 5. So we don't use this. So we recognize an asset as held for sale under IFRS 5. We don't say it's an associate. And if the company that we're dealing with is a subsidiary, so to speak, or partially owned by another company, then we don't need to deal with the associate. The the head parent will deal with the entire grouping of the whole thing. The associate is included, if you like, of course, as a non-current asset investment, calculated as cost of investment, plus, if you like, the share of post-ac profits, of course, like I said here, cost of investment, plus the share of post-ac profits, and of course we take away any impairment losses. So I say impairment losses, of course, the impairment of any impairment of that investment. So your investment itself could be impaired, and there's a standard on impairment that says you should be literally regularly checking. It's not a yearly thing. If you notice impairment, recognize the impairment straight away. Less any perps, so you cannot recognize profits to yourself, and we'll talk about that. So in the same way where you can sell assets to your associate and you would have made a profit, then you're recognizing the profit. You can't recognize, if you like, you need to eliminate any profits that you have, if you like, made on inventory that is still sitting in the stock of the associate, at least your share of it, if you like, because that's what you're adding to yourself, if that makes any sense. But we'll see questions on that. The group's share of the associates post-AC will also be included in the group retained earnings, of course, in working 5. So let's just sort of see an example here. I think that's the first thing, the best thing to do here. 1 second, let me just keep all of this, and let's go to a page. Oh, I thought I created a... I'm sure I... 1 second, let me just see if I created it. No, right, let me just do that now. Let's check here. 1 second, see. Did I bring that in? No, let me just check to see if I have a page. Oh, yes, I do. Okay, so I think what I just need to do is I've recorded too long now to stop. Let me just create a Word document and insert those notes very quickly. Insert picture. Desktop capture. Insert picture. Insert picture. Right, okay, great. So let's look at this. We have this situation here. I just want to use this to explain what's happening, and then we'll look at the answers. Here's the associate. They'll always give you this type of, oops, sorry, let me just draw that. Yes, so here is your associate, PO. Typically, when you have it, it'll lay it out in this way, where the subsidiary will be the first one and the associate will be next. And typically, you might have to go in there and actually analyze to see how much of the associate you actually own. So you see, it says 168. Oops, there's 168 shares in the associate. So you should really go and look at the total ordinary share capital of the associate. And if you look at that, you see that is 168 divided by 560. 168 divided by 560. You see that's 30%. So you can see that it's clearly an associate. You will not be consolidating all of these figures. We literally need to understand the profit from when you acquired it. And you'll be consolidating DIPSI and LA. And we have done this regular consolidation. This should not be an issue, especially in this question, where I believe the consolidation is pretty straight. It says DIPSI acquired the subsidiary when it had retained losses, so you can work out goodwill. You can see what's happening there and deal with that. And this is what I want to focus on. DIPSI acquired its share in PO on the 1st of Jan when PO had retained earnings of 140. So I'm just going to do this here. Why not? So I'm just going to, in a way, I'm almost creating a working 2. You do not need to create a working 2. Oh, when I say a working 2, a working that looks like working 2, but for PO. So I have here ordinary shares, 560, and net assets at acquisition, net assets at year end, 560. I know it's 448. I can see it. And then I have here Lala had retained losses. Sorry, when PO had retained earnings of 140. Then you have post-AC. Post-AC. So really what we're talking about here is what's happened post-acquisition. So, I mean, let's just see if there are any other adjustments. I doubt it, but an impairment test shows that goodwill for Lala remains unimpaired. So that's just working to subsidiary. You deal with that as we have done, as we're dealing with subsidiary. And also, they tell us that the fair value using, so this is also to do with that whole, the subsidiary. So the only thing here that we need for this illustration is what's going on with the associate, which is what I want to focus on. So if I look what's happened post-AC, that's 448 minus 140. 448 minus 140, that's 308. So I have post-AC of 308. So you own 30% of this business. So you are entitled to 30% of that. So 30% of that, if you like, is 92.4. So I am debiting my investment and crediting, if you like, income, profits from associates, that sort of thing, right? So let's look at how they deal with it. That's what I want to focus on in the adjustment, so you can see what's happening. So look at that. You can see that when I consolidate, nothing of the there are no assets of the associate in there, but it's the investments in the associate. Watch carefully how my associate started off at 224, right? 224. So let me take you to working 6. That's the key working here. So look at working 6. So that was what I oh, sorry, my asset was impaired. Sorry, I thought it was the who was impaired? Poe was impaired. So forgive me. 2,800. So can't forget that. That's important. Poe was impaired. So anyway, let's look at that. So we can see here in working 6 that you have your cost of your investment sitting there. Then you debit your investment again with 92.4, and you credit your income statement. This is just not showing, they're only showing the statement of financial position here, which is why you see me just debiting my investment. And of course, that's my an impairment, literally, which is now credit the investment and debit the earnings, right? Because we've lost 2.8. It's impaired. It's a loss. So 2.8. So basically, debit retained earnings, credit the investment with 2.8. So these are the only new adjustments here. That's the profit, of course, 92.4. Credit the retained earnings with your share of profit and debit the investment. So quite, I think, some very straight, clear adjustments on the whole at the beginning. Of course, we will see where there is a bit of a, when I say a twist, just the additional issues to talk about. What we will talk about in the next video. So really, it's about having a go and making sure you can do the working, and you then know how to lift the working and put it into the main statement. Okay, great stuff. We'll end that video there, and then I'll see you in the next video.